So this is the last gang between the conference and the cocktail party. So we're not going to go over the time limit. We've got some crude, we've got some product, we've even got a little bit of LNG tankers sprinkled in today. Bart Kelleher from Ardmore. We've got David Chapman from Tsakos. And from Navios, Ted Petrone, who's spent some time on stage this morning. So each of you, if you could spend a couple minutes talking specifically about your company and your strategy. We'll start with you, Bart.
Sure. Thanks, Jim. Happy to be here. So Ardmore, we have a focus on the product and the chemical tanker sector, serving customers on a global basis, pretty much all spot exposed, and really focused on the MR sector down to 25,000 deadweight ton chemical tankers, and the trading overlap actually between those different asset classes. Certainly, we've been public since 2013, have a strong focus on corporate governance, and actually with that process, actually just going through a leadership transition as our founder and CEO, Tony Gurney, retires, and a long time in the making, but certainly in terms of continuity of our strategy and a strong bench to lead the team forward. That's actually officially taking place next week as he wraps up. And our main focus as we trade in the spot market, it is all about the performance of our vessels and performing today, but then actually distributing our capital that we make across a range of priorities, including investing in our existing fleet, continuing to delever, and at the same time returning capital to shareholders in the form of a dividend, while also looking for investments that can build suitable value for the future. I think I'll pause there.
Excellent. Ted.
Jim, thank you. So Navios is 70 years old today. It started as a U.S. Steel subsidiary, but I consider us more of a 19-year startup. We had 5 different public shipping companies at Navios Group about 8 years ago, and we decided that didn't work in the long run, so we kind of reimagined shipping, and we put them all together under one umbrella and one corporation. And so I think we believe over the long run, I know this is a tanker panel, sorry, but I'm just going to go. The whole is greater than the sum of the parts. So we have 179 vessels, 151 in the water. About 40% are dry, 30% are tankers, and 30% are containers. So what we've done is really, we feel like we've smoothed out the risk profile, right? We've done cross-sector opportunities, so when one's down, the other's up. I mean, we took a lot of money out of the container side, put it into tankers, which were going on long-term charter. So we're optimizing our capital allocation. Because there's a negative correlation between wet and dry. Now, sometimes it goes up together, sometimes it goes down, but over the long run, it's somewhat negative. And even containers and dry, right? Finished goods and the bulk, it's probably about a 30%, so flip a coin, you have a better correlation. So over the long run, we're looking for long-term horizon investors who are there, like Richard Diamond, who's a friend of mine. Over the long run, we think we can generate enough cash. Our MO is we do time charter. Short, medium to long-term charter, wherever we are in the market, because time charter pays more and is less risk for the ship owner. Unless you get to the top of the market, then voyage charter gets higher and it flips over, and that's when we do long-term deals like we've been doing in the tanker sector now. We've started the buyback program. We've started the buyback because it was so confident in the market going forward that we did it before we outlaid some metrics that we had to hit. We haven't hit the metrics yet, but we're on our way. So it's tankers, and it's smooth following winds and smooth seas for us, all of us.
And David, Tsakos' perspective.
Thank you. Yeah, I think actually it's quite interesting. We're sort of in between Bart and Ted here. Tsakos Energy Navigation has been listed in New York now for 31 years. We're continuing our strategy of green transition whilst the market has been very kind to us in the last couple of years. We straddle the crude and the products environment and also LNG. And we also have expertise in the DP shuttle trades. We have 6 dual fuel, LNG dual fuel tankers on the water now. We also have ice class. We have a balanced portfolio of time charters to ensure that the business has financial sustainability, but we also keep our hand in the spot market across the sectors because we feel that gives us a very good insight into the way that the markets are developing. Over the last year or so, we sold 12 vessels, totaling about 1 million tons deadweight with an average of 17.5 years. And we've replaced, and more so, with acquisitions of 21 vessels averaging 1 year old. I think amongst all that, our policy remains one of caution and prudence, and above all, investing in the people side of the business. I think in the last presentation, that point was made repeatedly, that we need good people in our industry, and we need to invest in the future, not just in our ships, but also our people. And so last week, we were very pleased to announce that we opened the first ever private maritime academy in Greece, in our founder, Captain Panagiotis Tsakos' home island of Chios, initially with just 40 students, but we're pleased that that initial 40 was oversubscribed by a factor of 6. So for us, it's continuing with our robust growth and our transition to green, decarbonized shipping.
And Carlos, tell us about your company and your strategy.
Yeah, thank you. Thank you, Jim. We are a product tanker player, fully focused on the product tanker sector. We control a modern fleet, average age of 8.9 years, 33 vessels, of which 26 owned, 4 time chartered in, and 3 bareboat chartered in. 6 LR1s and 6 handy-sized vessels, and 21 MR2s. We have a number of purchase options that we have been exercising. We still have 3 purchase options on vessels, bareboat chartered in, and another 3 options on vessels time chartered in. One of these we declared recently, and the vessel is going to be delivered to us around the end of this year. And we plan to exercise the remaining options soon in the course of this year and next year. The options on the TC-in vessels are well in the money. The last 2 options we exercised, the purchase price is around 30% below the market value of the vessel. We plan to continue investing to make our fleet as efficient as possible through a number of devices and measures. A lot was done, more can be done, and we will continue down this route. There are lots of new technologies coming up, and we continue studying them to see which ones are more attractive and should be adopted by us. We have substantially delevered our balance sheet over the last few years. So as at the end of June, the ratio between the net financial position and fleet market value for us was of only 9%. A few years ago, we were at 73%, so that's a great achievement for us. Deleveraging is not a priority anymore, although as long as markets continue being as strong as they are today, we will continue generating quite a lot of cash. And so naturally, some more deleveraging is going to occur. But we are also looking to to reward our shareholders more going forward. So this year, given the very strong results we have already achieved and we expect to achieve in the rest of the year, we should be paying out more dividends as a proportion of the net profits than we did last year. And we are also quite active on the share buyback front, especially because the shares are currently very depressed relative to intrinsic value, NAV. And so we are taking advantage of that. We have some older vessels in our fleet, which we will be selling. We have 3 vessels which were built in 2011, so we will be selling these possibly over the coming 2 years. And we have ordered 4 LR1s, which is part of this fleet renewal that will be replacing the vessels that we will be selling. And these LR1s will be delivered to us starting in the second half of all of them actually in the second half of 2027. So by the end of 27, according to this, let's say this plan, which of course is always subject to change as market conditions evolve and new opportunities arise, we should have a fleet of 33 vessels, all owned, and 31 of these vessels eco-design vessels. So we would be in a very strong position.
Thank you. So we're getting closer to what's usually a strong winter season. Let's focus on the demand side of the equation, thinking about crude and product. And what are your views on the demand side of the equation? What are the biggest fundamental risks to that? And if we're going to have a strong winter season, just let us know exactly when that's going to start. Bart, we'll start with you.
I don't know about exactly when it's going to start, but I think we're seeing the typical seasonality play out, and certainly you see where typically Q3 does decelerate through the summer. Are we at the start of the point of inflection now, where we're seeing some incremental cargoes in the market, but yet to start ticking up on the TCEs? I think we want some visibility as the refineries come back from their maintenance periods, and in particular in the U.S. Typically that's more of like in October, so let's just see how things advance in terms of October. But certainly we're feeling that we're starting from a very strong point, where year over year, when we reported like our last earnings, our forward book for Q3 was up considerably versus the prior year. And so with that typical seasonality shape, it's always the debate of what does that look like for acceleration through Q4. So I don't think any magical answer. I think, we understand there's different macro headwinds, obviously in terms of OPEC Plus, and I'm sure we'll have some commentary on the crude side, and a macro front in China. But I think in terms of what we're seeing for the potential setup for typical seasonality, and the continued boost from some of the geopolitical situations that seem to have much stronger persistence, we're still very excited about the upcoming winter market and our operating leverage, given that we've really driven down our cash break even to quite low levels, and think by the end of the year we're probably below $11,500 a day. So we can generate cash in almost any market.
Carlos.
Yeah, I agree with Bart, and I will add that the relative weakness that we are seeing right now in the product tanker market, relative because it's still very healthy rates that we are achieving on the spot market, is very much linked to the weakness that was experienced, and which is possibly occurs quite often on the crude markets over the summer. The crude markets are possibly not as tight as the product tanker markets, especially the VLCC market, I would say. And therefore the seasonality plays a bigger role in that market. And what we saw, which was quite exceptional, we saw in the past that vessels being delivered from yards would perform maiden voyages transporting gas oil. But instead this year we saw a much more aggressive practice, which was cleanups of VLCCs and Suezmaxes that were 37 VLCCs and Suezmaxes cleaned up to transport CPP. And that's quite exceptional. If you measure it as a percentage of long-haul voyages, 13% of CPP was transported on non-coated tankers in July and August. So that is the highest figure of the last 20 years. And I think that's the main factor which explains this relative weakness in the product tanker market. And I believe I'm quite positive about the outlook for the crude tanker markets. There is more supply coming, irrespective of what OPEC decides to do. And this new supply of oil that is coming from Brazil, from the US, from Canada and Guyana, so it's going to be contributing quite a lot to ton miles. And so hopefully these markets are going to start improving actually very soon, as is usually the case. Very few crude tankers delivered. The VLCCs, I think only one vessel to be delivered at the rest of this year, and only 5 next year. So it's minimal levels. And so the strength in that market should further support the product tanker markets going forward.
Ted, what could go wrong?
If you want my elevator speech, I think maybe the tailwinds may slow down a bit, but there's no headwinds here. I take Carlos's point. I want to put some color on what Carlos said. You know, like on the dry side, all the discovery of natural resources in the West, oil, you know, people have underestimated the shale with technology. We're up at 13 million. We're the biggest oil. The U.S. is the biggest oil producer in the world. Guyana's coming on. Libya's a problem. So you have a ton-mile issue that's lending, no matter what happens with, as Carlos said about what happened OPEC does. OPEC used to be the Federal Reserve of oil. They're no longer the Federal Reserve, and they can't call the shots. I think they underestimated shale oil, so they're stuck in a position. Still, I would say more than 50% of crude that is going to move through the Straits of Hormuz is coming out of there. So that is a potential problem. But I agree. I think the same thing on the product side. You know, you have a lot of refineries shutting down. The core OPEC, the 4, have decided finally to crack the barrel the last 5 or 7 years. So that's coming out and going out back west and also east. So we got into the product sector 10 years ago because of the ton-mile issue, and that's been a big thing. You know, million ton miles. You have day miles. So we're very optimistic going forward. We, you know, just as an anecdote, I would say the smart money started coming to us because they knew we were period, right? Some of I would say the oil majors and the major oil players. Our phone started ringing about 2 years ago, and they said, "Oh, you guys going to put out your ships on period?" And we're like, "Oh, you could wait. Let's all wait," because we all saw the same numbers going down the road, right? No steel, and I think what happened is, here's an old trader with an old quick story. Period market up to 3 years, I think, starts with the trader because I've been there. I walked into my boss and said, "I'm going to lose $1 million if I relet this cargo, but I can get a ship for 2 years and I'll break even." But if you're doing 5-year, 7-year deals like we're doing at over 20-year averages, that's come from senior management. And senior management said, right, containers didn't make a lot in the decades, and neither did oil tankers. But so their portfolio approach was 5-10% of their delivery system was on long-term charters just in case things went wrong. I think that's gone up to 25 or 30% because there were more phone calls coming in than us going out. And that's where you've come in, where we've got a big push on time charter. On the spot, we've kept some of we have 10 Vs, we kept some of them on the spot. Unfortunately, the Vs have, you know, the sanctions have kind of worked reverse, right? The Vs have not done as well as the Suezmax and the Aframax because of the loading logistics on the sanctioned cargoes. But overall, it's a good time to be a tanker owner.
Thank you. And David?
Yeah, that's, I think that's pretty well covered, and going last here doesn't leave a great deal to add. But
no one gave us the date yet. You're going to tell us when it's going to take off.
Yesterday. Dave, Bart was right. It started already. Sorry.
Speaking as somebody who joined the tanker industry when VLCCs were at world scale 17.25, I would say it took off already. But yeah, we've had a phenomenal couple of years, and you could almost say that the market was upside down, with the product carriers having their well, more than a day in the sunshine, which led to this cleaning up of large crude ships, which is, I don't think, a long-term sustainable strategy for a lot of reasons. What I would say is seasonality, I think, is with us, and if I could tip my hat to the LNG sector ever so slightly, we always anticipate a bull run during Q4. It's maybe a little bit subdued at the moment, but that cannon does turn on a sixpence in that market. Products market has always been seasonal. We've always had the various, whether it's the driving season, the heating oil season, you name it, there's a season that people expect the markets to rise, and I don't see anything different in this year. What I would say is, on the longer term, there's some really interesting tailwinds on the crude side. From a shipping perspective, we're still benefiting from the fleet age profile, and that's undeniable. On the oil price side, I think, as well as looking at whether there's some softening in the oil price at the moment, what we also need to look at is what the international oil companies are doing with respect to reducing their cost of production. And in particular, the shale oil, as Ted mentioned, there are moves afoot to try and get that down by as much as 50% from, say, mid-50s into the high 20s. And of course, Guyana, as Carlos mentioned, people are talking about a $25, $30 cost of production there. So this is a new reality in the future to look at versus OPEC Plus and the traditional mindset of where the demand's going to come from, where the supply's going to come from, and what the economics of the barrel are going to be.
Let's switch to one of the common topics of the day, the dark pool. How does it impede the tanker market, and is there anything that can be done to tackle that issue? We'll start with you, Bart.
So I think maybe just from the practical supply-demand approach, I mean, obviously you have a number of vessels that aren't competing in the global fleet, so that's impacting ship availability and reducing the effective supply of the mainstream fleet. So that's further supporting the market, and I think we see a stickiness there, and where you don't have this back and forth. Our current numbers are showing us that the shadow fleet, or whatever you want to call it, is approximately 1,200 vessels, 17% of the CPP fleet. Average age 16 years. I think we'll probably hear it like on the crude side, maybe a little bit older, but really considerable part of that fleet. I think for us at Ardmore and like the other quality owners, we'll continue to comply with all sanctions, really track the evolution of them. It's quite a dynamic environment, and focus on servicing our customers, and really with that emphasis on safety and efficiency. And it's not just sanctions, but I think just obviously the world is a much more dangerous place today, and we really have to think about our seafarers, and when we talk about attracting others to the industry, and for that next generation, our actions today and how we actually manage our fleet through these more difficult times on the water is just absolutely essential.
Carlos.
Yeah, no, I would like to add to that I mean, it's difficult to measure how big this fleet is. There are different numbers which are reported. There are some which are very dark and some which are gray. It is definitely more meaningful for non-coated tankers than for coated tankers. I mean, a reputed source figures would measure the dark fleet at 475, of which 425 being non-coated tankers. So it's a significant proportion of that fleet. I think the big question here is if authorities are going to be more stringent in their application of the rules and in checking these vessels, which would result in more vessels being directly sanctioned. There are around 110, just over 110, which are already sanctioned. Some of these are stopped trading, some continue trading, but in a much more limited way. At least they cannot benefit from both markets and switch from sanctioned to non-sanctioned trades once they have been explicitly sanctioned. There's room for more vessels to be explicitly sanctioned. I heard Ukrainian authorities have identified another 80 vessels which could be easily sanctioned. And then the big question mark is what happens with these vessels once some of these sanctioned trade opportunities are not there anymore. Most likely the more vessels are directly sanctioned, the more of them will have to be demolished, and that will help the markets if eventually some of these disruptions that we are benefiting from are not there anymore.
Thank you. Ted?
Sanctions don't work. They didn't work. I think they tried to thread the needle here, but the $60 cap on the pricing, because you didn't want to punish Russia so much that they would go limited nuclear, maybe, and you would be crushing the Western economies because you'd have oil at $120. So you're having this dark fleet, gray fleet. Nothing's going to happen until there's a huge oil spill, and we almost had one in the Red Sea. What helped the dry 20 years ago was there was a huge oil spill off of northern France, and it ruined the summer for many Europeans. And then there was the problem with regulations are they're retroactive looking. The industry needs to be proactive in green and everything else we're doing. But I think the sanctions aren't working because these ships are going to keep trading. And as Carlos said, what if peace happens tomorrow? Europe's not going to go back right away to taking LNG and oil from Russia. But there will come the day, if those ships scrap, maybe they do. But I would say they'll probably keep trading. Let's say it's 80 million deadweight. But the utilization rate on those ships will probably be 50% because they're sitting around a lot. So they'll act as 40 million deadweight in the market. So, we do these projections, it's half science, half artwork to get going. But I don't see this anywhere in the near future, these sanctions being lifted or these gray fleet coming out. And it's going to be, unfortunately, an ecological disaster that's going to maybe move the needle. That's usually the case in the world.
Thank you. David?
Yeah, we don't and never did compete with the dark fleet. As a listed owner, we comply with all the regulations that are out there, which are increasingly complex. I think I read somewhere that just the European sanctions alone is now 14 different sanctions that run to 1,200 pages. So it's a complex issue for owners to make sure that we always comply. But as far as the dark fleet is concerned itself, these were effectively the ships that were undercutting the normal market in the first place. The older tonnage, perhaps some of the ownership was already not ideal, and with the transfer of ownership and the passage of time, these ships are not getting any better. And for those ships to be, the concept of them coming back into the regular market, we all know what it is to maintain vettings and approvals and port state control inspections. This is a huge issue that hopefully means that those ships will just end up as razor blades. So for us, it's actually been a positive because those ships were not just taken away from the regular market, but were actually the ships that were undercutting it in the first place. Our big concern, as Ted just mentioned, and Bart as well, there are huge safety and environmental risks in the world right now with these ships. Sadly, you don't like to say this normally, but it is an accident waiting to happen. And to touch on attracting people into our industry, the last thing we want is the pictures on the news like we used to see with burning tankers in the Gulf, or oil pollution on the beach, that famous cormorant that flew around the world coated in crude oil for 20 years. We don't want that image in our industry. And what we do, I don't know how we prevent it, but we need to find a way to stop that happening.
Next question. You only have two choices. You can order a new build, or you can buy a 5-year-old ship. And what day rates do you need over the next 3 years to justify your answer? Start with you, Bart.
Tough. I'd say it's situational. I mean, I think all of us probably are always looking at the sale and purchase market, examining secondhand vessels, as well as new builds, and trying to understand the relative value differences. I mean, we fairly recently did do a pair trade where we sold a 14-year-old and bought a 7-year-old, and when we looked at that set of transactions, we thought, we're selling a 14-year-old at quite a favorable price. Are we paying quite a full price for the 7-year-old? So it's, I guess, near your 5-year-old question. Yes, but when you adjust for the fuel efficiency, we're buying 7 years at a rate that is equivalent to our fleet's depreciation rate today. So I think there's room for, over the course of time where you have to rejuvenate and modernize your fleet, and that in today's market can be quite a measured approach in way, as opposed to at today's values looking to really go long in some larger deal. I think the challenge to your question is, there's really not many secondhand vessels available, and certainly when you start talking pricing levels, and for that age frame, quite a challenge.
So you got two choices, not three choices. You got two choices.
Two choices.
And by ordering a new build, you're not getting it in the next 2 years.
Yeah. Can I have 3 or 4?
No, you can only do choices.
I would buy back our own shares, which we are doing, and exercise the options that we have. No, actually, this pair trade, which Bart mentioned, we were very close to doing something very similar, and we actually signed them over to purchase a vessel just after we had sold one 14-year-old also, and we were buying a 7-year-old. Then the purchase didn't end up well, unfortunately, not for reasons that we controlled. But it made sense also to us. So it's a slightly different answer from your question. New buildings, are delivered in the future. They are better vessels. I was actually surprised when we ordered our LR1s to discover that, at least on paper, these LR1s are 8% more efficient, around 8%, than the last LR1s that were delivered to us in 2019. But it depends greatly on the assumptions you're making when you're running these calculations, how long you expect to hold the asset. Of course, the longer you expect to hold the asset, the more the new building makes sense, because it's a better vessel in theory. But I would say that right now I wouldn't be increasing, and that's our strategy. So it's not to increase the size of a fleet. We bought the four LR1s with the idea of replacing some vessels older vessels that we would be selling. So it's.
All right, Ted, you're going to give me an answer, aren't you?
I'll try my best. This is what we do. We were successful on investing in containers and tankers before things went up. I mean, look, sometimes you get lucky. Luck is a residual of design. We're all hard workers. But our philosophy is to get new buildings, buy new buildings, and charter them out for long periods, say 5 years, where the residual value risk is well below the 20-year averages of the asset value and the time charter you need to break even. And we've been successful in doing that. Now, maybe the market changes and we go forward and do 5-year-old vessels, but I don't see that happening at this point. I mean, you can't do it in dry, you can do it in containers, you can do it in tankers, because that charters lend to doing longer voyages because they want to control the steel. And when you get to the top of the time charter period, when you go to those longer periods, there's people like us here in the top of that pyramid, charters and owners talking to each other. So there's not a lot of play you know, the longer-term deals actually get done quicker than short-term deals because both parties know what they want. It's just a matter of talking out the details.
David?
Well, my flippant answer was going to be that this year we did both. So at the beginning of the year, we took delivery of 3 to 5 year old vessels from Viking with charters attached, and we've got a series of orders that we placed during the year, including 5 LR1s. The more serious answer right now is that I think we are averse to ordering anything on spec. We don't want to add to the tonnage and at the same time add to our risk on our balance sheet. On the 5-year-old vessels, I agree there is actually a shortage of quality candidates, which tends to mean that in some sectors, Aframaxes, for example, they're priced very, very similar to a new building.
But you don't have to wait. You don't have to wait 2.5 years or 3 years.
But as Carlos said, it's significant what the efficiency difference can be. And if I can put my LNG hat on again for a second, an LNG carrier delivered in 2021, the first generation 2-stroke, is significantly less efficient than a 2-stroke that you would order from a yard today with delivery 27-28. And in particular, the methane slip, which is going to be a hot topic going forward, has been substantially reduced in the engines that you would order today compared with 2021. And when you consider what the residual value is going to be after a 10-year charter on an LNG carrier, it's still pretty substantial. And the sustainability of ordering a vessel for and only putting it against even a 10-year charter, you've got to make sure that you've got as much future proofing in your design as possible. So I would say on the LNG side, I would be very strongly in favor of the new build, provided we got a decent charter to order against.
All right, we're running out of time, so this is the last question. You each have a maximum of 30 seconds. What happens if peace breaks out? What happens to the tanker segment if peace breaks out? Bart.
Well, 30 seconds, important to note, I mean, I think, like, look, the world wants and needs peace, but there probably, unfortunately, isn't a near-time resolution in the different troubled areas. So I think there is a persistence there. For the product tanker sector, the Russia-Ukraine conflict and the EU embargo is probably much more significant, in particular for the MRs, as opposed to the Houthis in the Red Sea. I think certainly talking to our customers and charters across Europe, there's a stickiness to strong desire to source from a wide variety of countries and producers for refined product. And so I think that actually has much longer legs. I mean, one, unfortunately, because the conflict likely persists, and then even well beyond that.
That was a long 30 seconds. Carlos.
So, yeah, I unfortunately, I think that, you know, the piece is not that simple. I was wrong when these two conflicts started. I thought a solution could be found much faster. Eventually, hopefully, a solution will be found, and undoubtedly, for us, it will not be positive. I mean, it's if it is the Suez Canal resolution that comes first, we would probably, I would say, go back to a market which is similar to the one we had in the last 3 quarters of last year, which was still a very good market, but of course not as brilliant as the market we had in the first half of this year. I agree with Bart that the Ukrainian conflict had an even bigger impact in our market. I was looking at the ton miles increase over 22 and 23, and it amounts cumulatively to just over 12%, and volumes over the same period increased by around 6%, volumes transported, refined products by sea. So a lot of this ton-mile increase is attributable to the conflict. How much, I don't know. And so that is probably the maximum delta in demand. I think, of course, there were other factors which contributed to the increase in ton-miles, greater imports from Australia because of refineries shutting down there, and then new refineries coming up in the Middle East and Asia contributing to ton-miles. But an important portion of this delta was linked to the war, and that's the maximum negative effect that we could have, I would say, from the end of the conflict.
Well, my screen is flashing times up. Unless, Ted, you can give us
30 seconds. I'll do it 30 seconds.
Okay.
If peace breaks out in the Ukraine, nothing's going to happen because Europe is not going to go back to taking LNG and oil from Russia. It's maybe on an incremental basis. And as an American, I want to say, if the Biden administration grows a backbone and take out the Houthis, I think you will reset to a lower level. But I mean, we've been over 20-year averages for the last year and a half. Maybe we're just under it. It's still a very good market, but not like today.
20 seconds? 10 seconds. Okay. Tramp shipping flourishes when we have open seas and no restrictions and no costs. So in the long term, we want peace in shipping because it increases trade. We'd also consider that in a Pollyanna-ish future and everything's in the garden's rosy, the rebuilding of Ukraine, Russia, Gaza, Yemen, there's a huge potential for increased trade and shipping, wet and dry, right there.
Great way to end it. Thank you very much. Thank you, panel.